Hello, greetings. Welcome to Dividend Blasters. This is our 112th video, and our topic today is BLOKS. This ETF delivers weekly cash flow and zero NAV erosion. So I just did a video on BLOKS. Why am I doing another one so quick? Very good reason. I'm doing this because I believe that this ETF may be the very best ETF that does two things. It blends exposure to digital assets, the blockchain, and the crypto innovation space, and all the volatility that goes with it. And we know that is significant. What is that? This space comprises Bitcoin, uh, Ethereum, some of the other coins, which I'm not going to get into, but the companies that support the mining and the trading of these digital assets. And this is all very volatile, but it's also a good thing. And I'm going to tell you why. But what else does it do? It delivers steady, consistent weekly cash flow. That's what BLOKS does. I'm going to say that again. This is an income based ETF that delivers steady, consistent weekly cash flow. And also, very, very important, there is no evidence of NAV erosion. There are a handful of income based ETFs that pay out weekly that are in this space, but I see evidence of NAV erosion. I don't see it here with BLOKS, and that's why I think that this is very special. I want to cover this. So I'm going to drill down a little deeper and talk a little bit how they compare and why I think that this is an ETF to think about. But first, a little housekeeping. What I say is not financial advice. This video is for information and education. It's based on my opinions, research, and experience as an independent investor for more than 30 years. So do your own research and due diligence before making any major investment decisions. So, BLOKS, what are its objectives? Well, interestingly, this is an income-based ETF, but its primary objective is market performance, capital appreciation. That's fascinating. And why is that? Because that's telling me they're saying without saying, we don't want NAV erosion with our fund. We're an income based ETF, but we want to capture price appreciation. I love that. And especially when you're talking about this space, the blockchain, digital assets, Bitcoin, Ethereum, you want that market performance. That you don't want to give that up. Second objective is having that consistent weekly distribution. And when I read this, I'm like, okay, wow, they want price appreciation, but they don't want to sacrifice that uh, to maintain that weekly distribution at a certain level. That to me is telling me they want market performance, but they're not going to, uh, try to maintain a particular distribution level. They'll vary that if they need to get that market performance and also protect against downside. And this all really goes to their options overlay strategy. I'll talk a little bit about that. And then another objective is this. I talked about some of the other weekly payers in the space that I think have NAV erosion. So it's different from those, and I think better. But there's other ETFs that are not income based. They're there just solely for market performance, and they're going to capture greater performance in a bull market. In a bear market, they're going to suffer a little bit more. The difference here is BLOKS has what they call a three sleeve structure, where they're balancing the income they're generating with the market performance they're capturing by getting exposure to this space. And it's a very innovative space, and there's a lot of volatility space in the cryptocurrency, blockchain, digital asset space. And let me also say this: I invest in one of these ETFs that doesn't pay a distribution. It is solely there for market performance, and I love it. It's actually IBIT, um, and it's by BlackRock's iShares, and I get full, replication of what's going on with uh, basically Bitcoin. Um, and that does something different. This does something different. So I'm not saying this is better. I'm saying it's different, and I have them both, and I like them both. And I will also tell you, and you know this if you've listened to my videos, uh, I do hold Bitcoin in a retirement account. I own quite a few of them, and I'm glad that I do. I've held them for years. I hold quite a few Ethereum as well. Also physical gold and silver and another retirement account. These all sit in a vault out of state. Okay, so that's basically what BLOKS' objectives are. Let's talk a little bit about Bitcoin and Ethereum because I think it's important to give you that context. And if you watch the news and you look at you know, the indices, you know what's going on with Bitcoin. But let me just give you some historical perspective. Both these digital assets have dramatically outperformed the market, the S&P 500. Not even close. They're also much more volatile. There's more risk in them. So that can be potentially difficult, but also can be very rewarding. Remember, there's a risk reward trade off with these assets. If you go back to since Bitcoin launched in 2009, they've returned over 125 million%. There is no other asset that is even close. Ethereum, 546% since it launched in 2015. Lots of volatility. All right. And here is just a graphical depiction of Bitcoin and Ethereum. You can pause it and take a look at it, but I've already talked about it. And here is just for comparative analysis, you can see that the NASDAQ 100 in the last 15 years has returned about 1,200%, a little less. The S&P 500 almost 473%. And these are great returns, and I invest in ETFs that replicate these indices, as well as some covered call ETFs that also generate options as well as replicating, but not even close to Bitcoin. So why am I telling you this? Telling you this because it is, I think, it behooves us all to pay attention to Bitcoin. This is, in my judgment, an inflection point, has been an inflection point for many years, that these digital assets are game changers. And to ignore these, I think, would be foolish. I don't think you want to miss out on potential returns here that have been gained or can be gained. And I am glad that I own these. So I'm speaking from experience. So I did mention the volatility. Why is this important? When you invest in an income-based ETF, and let's say BLOKS, for instance, but really any income-based ETF, it has an options overlay strategy. They are looking to collect premiums, and they're going to generate those through options trades, call options, very likely. The more volatile the asset they are writing those options contracts against, the higher those premiums are. And it doesn't matter whether the volatility is positive or negative. Will the price go up or the price go down? Doesn't matter. There is more risk, and with options, you will generate more premiums based on the risk or the volatility. So if the volatility goes up, the price of the option goes up, and the premiums go up, and you could potentially collect more premiums. When do they go down? When the volatility goes down, the premiums flatten out. So, and think about this: why would somebody uh, sell a call option? Well, they want to collect premium income to manage downside risk of an underlying investment. And the question: why do you invest in an income-based ETF? It's the same exact answer: to manage the risk. So, and I already mentioned, volatility increases, option premiums rise. Volatility decreases, options premiums fall. Uh, I'm mentioning implied volatility here at the bottom because it's a real thing. It's a real metric when you are selling an option. There's a metric there that basically reflects what the market is expecting the price of the asset to do. So if there's greater implied volatility, it's expecting greater movements. And if there's greater movements, the options premium should be higher. And depending on whether it's up or down, and that's going to impact your strategy. I'm not going to get too much into that because that's another video altogether. So let's talk about blocks. Blocks closed Friday, October 17th at $24.70 a share. What you see here, they've been operating for about 4 months, is primarily an upward trend price-wise. The expense ratio is 103 basis points. So you invest $10,000, you pay $103 a year. Now, it's going to be a little bit more pricey than your standard index fund ETF or even your dividend growth ETF. You're paying for that options overlay strategy. And that is, there's a skill there, and that's what you're paying for. Otherwise, you know, go ahead and buy the underlying assets and do your own calls. And if you can do it, great. But here you don't have to do it. And I like to do both. I always learn more by watching these guys. I think it's fascinating. The yield here, and I already mentioned, 9.24%. Here it says 9.45%. It's a negligible difference, just depending on where you look in Seeking Alpha. Updating over the weekend sometimes might take an extra day. The assets under management, and this is for 4 months, almost $147 million. So pretty impressive growth. And those assets are stocks in the blockchain, of companies in the blockchain and the crypto space, as well as ETFs that may have direct exposure to Bitcoin and Ethereum. All right. And there's the distribution. Here it says 9.24%, so it's about the same. The major takeaway here is that it's a weekly pair, and that the last distribution for this last week was 18 cents per share per week. So that would be, if you were to extrapolate or get a general estimate per month, about 72 cents a month. And that comes to about $8.50, $9 a year. And you know what? These weekly distributions are going to adjust a little bit. Some will go up a little, some will go down. But what I like about what I'm seeing here is I don't see drastic fluctuations in the distributions. Pretty gentle. They go up a little bit, they go down a little bit, but mostly flat and slightly up in that bar chart. And then here's a table. Same thing. Essentially, though, what you see is when it first started in early July, you were in the 14-cent range, and now you're in 18-cent range. So that's a general uptrend. So when you compare this ETF with the market, and we're just looking at 4 months, they're more than doubling the S&P 500, almost 29% versus 13%. And this is just the price return. You look at total return, it's more. It's almost 44%. So what that tells me is that of the total return, 2/3 of that, a little more than 2/3, is price return. And this is an income-based ETF. So 28% price, 16% income. So this this income-based ETF prioritizes capturing that market performance, which I love. And again, why are they doing this? They do not want NAV erosion. They're sensitive to that, and I love that because there are a lot of ETFs, income-based, that are not sensitive to that. And you know what? If some folks want to do that, that's fine. It's a personal preference. I personally, I want an asset that is continuing to grow. And I'm not talking about, oh, there's a price downtrend here, a market fluctuation. I'm not talking about that. I'm talking about NAV, underlying value of the assets. If I hear about a fund that is all of a sudden liquidating assets so they can meet a weekly distribution, I'm going to sell it. That's just my own preference. I want a growing NAV. So what I'm doing here is I'm going to do a couple things. I'm just going to do a quick comparison with some of the other weekly payers, and I found 5 of them: BITO or ProShares Bitcoin ETF, YBTC Roundhills, Bitcoin Covered Call Strategy ETF, BCCC Global X Bitcoin Covered Call ETF, COIW Roundhills Coin Weekly Pay ETF, and LFGY Yield Max's Crypto Industry and Tech Portfolio Option Income ETF. These are all weekly payers. A couple of things that jump out to me are um, the expense ratio. They're all about 100 basis points. BLOKS is a little bit more, 103 basis points. The others are 95 and 99, with the exception of BCCC, which is 75 basis points. So, there is a little bit of difference. And then also, but not much, but also the assets under management. BITO is by far the biggest. It's 2.65 billion. The others are in the hundreds of millions, with the exception of BCCC, which is under 13 million. That is the smallest. But I would say what I like here is that BLOKS has only been around 4 months, and they're already at 147 million. After 12 months, they could be a $400 million fund. So here we're looking at the distribution yields. What's abundantly clear and jumps out at me is BLOKS has a lower distribution yield, but I think that's a very reasonable, generous yield. I think that these others that are north of 55% are probably exorbitant. And if I see, for instance, the price performance going down, and yet they are distributing these distributions, that leads me to believe, well, maybe there is NAV erosion. There could be. A lot of these ETFs have direct or indirect exposure to these digital assets, but I don't think they have the cushion, and I don't think they have this three-sleeve strategy that BLOKS does. So what you're going to see, and I already know this, is you're going to see a better price performance with BLOKS than with these others. And really, I'm just looking at the first 6 months or so, first 4 months, essentially. BCCC has a more reasonable distribution yield, but I'd be interested in looking at their price return. But we can take a look at that. So let's take a look at that. Well, look, for 1 month and for 3 months, they're all very negative. Well, BLOKS is positive for 1 month and 3 months. Now, I would like to see. Hey, and you may be saying, well, 3 months. What about 6 months? Okay, well, they haven't been around for, they've been around for 4 months. Okay, so we're using the information we have, but they are a weekly payer, and so there's been at least 24. 16 distribution payments that we can go on. One thing is abundantly clear is that BLOKS is green and they're all red, with the exception of the 6-month performance for COIW and LFGY. But they're red for these first months. And I'm wondering, are they over distributing? Are there options trades going against them? I would suspect that they are, whereas BLOKS is not, and they're maintaining a weekly distribution. But here we can take a look at that price performance. Wow, take a look at that. By far, BLOKS is killing the others. All of the others are negative. BITO minus 7.73%, YBTC minus 14.5%, BCCC minus 11.17%, COIW minus 21.99%, LFGY minus 28.9%. And I'm looking at 1 year, but again, BLOKS hasn't been around for a year, but right now they're just outperforming. And this is only based on 4 months of data. And they're not just positive, they're almost 29% positive. So that's price return. When we look at total return, we're going to see how these perform with the distributions. And okay, BLOKS is 44%. So BITO actually comes up to almost 50% total return. That's pretty good. All the others are significantly less. So BITO is okay. That's good. They're generating positive total return, almost 50%, but they have a negative price return. Why do they have a negative price return? I'd like to see, and going back to the objective, the balance. I like to see balance. And right now, I'm not quite seeing balance with BITO. They're very heavy on income and total return, but they're not too good, I think, on price return. That's just my opinion. Okay, so um, there you go. So that is how they stack up against other weekly pairs. So just to kind of underscore what I've talked a little bit about and give you a little bit more detail on the three sleeve strategy. It's three things. It's an equity sleeve where they're investing in companies that work in blockchain and fintech stocks. And I'll talk more about these briefly, but the crypto mining companies or the crypto exchange companies. So again, it's not direct exposure to Bitcoin and to Ethereum. It's an indirect exposure through the companies that facilitate the mining and the trading of these digital assets. And there's also what they call the crypto sleeve, where they invest in ETFs. There's a couple of them. There's actually three of them: HODL and ETHA. One is by Van Eck. ETHA, I believe, is by BlackRock, and I believe there's another one with Fidelity. I'll show it to you later. And why are they investing in these? Because they want to capture price appreciation. And these ETFs have more direct exposure to those digital assets, Bitcoin and Ethereum. And then the third sleeve is the options overlay. We've talked about options overlay a lot in several of videos. And really what they're doing is they're writing call options and they're writing put spreads. And why do they do this? They write the call options to generate premium income as part of what they're going to distribute. And why do they do the put spreads? They want to protect against market downside. It's protection, essentially. It's like insurance or risk. So a little bit more about the equity sleeve. Here's a few things they invest in. Crypto mining stocks, Marathon platforms, Riot platforms, used to be known as Riot blockchains. Some of the payment processors and trading platforms like Coinbase, which is a full-fledged crypto exchange. They also invest in Robinhood, which is a full-fledged financial exchange, but you can trade Bitcoin and Ethereum on it. Another pair called BLOK, they invest in. They also invest in some of the decentralized financial infrastructure and fintech technology firms. And I'll talk a little bit more about that later. What is the goal? The goal is to get exposure to this space. Okay, this it's a very innovative space where the returns have been extraordinary, but they're very volatile. So they want exposure, but they also want to manage that volatility, and they're doing that through the options overlay against the first two sleeves. And here is just, I get this from their site, the top 10 holdings, a little bit more detail. iShares Ethereum Trust, Galaxy Digital, that is a mining company, IREN Limited, Hut 8, Riot Platforms, those are mining companies. Robinhood's Markets, okay, so Robinhood is a full-fledged financial exchange. I already mentioned that. Another mining company, Cipher Mining. And now we have the chip company, the Foundry, the Taiwan Semiconductor, which is a phenomenal investment. Mara Holdings, another mining company, and of course, Coinbase, which is a full-fledged crypto exchange. Those are just the top, excuse me, the top 10. And here I'm just listing, and you can read this. I'm not going to read through them. All 88 of their holdings. What you'll see here is after maybe the first 20 holdings, you have a bunch of options contracts. So you can see in the stock ticker, those are the names of the options, and then you see in the next field a description. And just for your own edification, that first one is a put option on Hut 8, and it expires October 31st, and the strike price is $50. That's the put option. And if you go through these, you see a bunch of put options. And again, it's to manage the downside risk. When you see the call options as you go down here, it's basically going to be for income. I see a lot of put options. So these options serve different purposes, as do exposure to these holdings, these top 20 or so. So just a little bit more detail on the crypto sleeve. And I think I mentioned this, and I know you definitely mentioned this in the previous video. BLOKS does not have direct custody of Bitcoin or Ethereum. It's not their business model. It's not what they want to get into the weeds on doing. It's not even their skill set. Their focus is essentially get exposure to the blockchain companies, the digital assets through the companies that work with those digital assets and the ETFs to get that exposure, but also to generate options premiums by writing call options and put spreads. So they're getting that exposure and they're managing the downside risk. That's why they do that. Do not want to take on the added responsibility of managing digital wallets, digital keys, and the risk that goes with that. Don't blame them. So this options overlay sleeve, this is where this active management of the ETF comes in. They actively manage generating those options premiums. I already talked about. They sell the calls for options income or premium income, and then they sell the puts, buy and sell the put spreads to manage that downside volatility. They want to preserve any upside gains. They don't want to ultimately have to drain the underlying assets to maintain a weekly distribution. And this is really what sets them apart, I believe, from some of the other weekly payers. You saw the price performance. Some of these others are invested directly in the digital assets, uh, and maybe they're writing options against, or I'm going to say it like this: they're investing in assets that have direct exposure, and very likely they are writing options against all of their holdings. And the price of their fund is going down. So you're having a negative price return. And yet they're maintaining these high distributions. The only way to do that, if you are not collecting enough income, if the value of the fund is not increasing concurrently, the only way to maintain those distributions is to sell the underlying holdings to get the cash to pay them out. Nobody wants that. I don't want that. I want a growing asset base. And I want them to be able to do this weekly. And so far, from what I've seen, BLOKS is doing that. So here's something kind of interesting, and I'm not surprised by this. How is BLOKS doing against some of these crypto ETFs that are not income based? They just are replicating price performance. Well, this really is going to depend on the market performance of Bitcoin and Ethereum, which are the two biggest ones. Year to date, they're outperforming. They're outperforming IBIT, which I own, FBTC, GBTC, and HODL. That's because there's been some volatility in the market performance. BLOKS does not invest directly in these assets. They invest in companies that work with these assets or invest in these assets, as well as ETFs. So it's a little bit more cushioned, and yet there is that those companies are performing well, and also there's that income layer. So by far, but that's just year to date. If you look at the last year, we open it up. Well, it's still performing well, 44%, and this is only 4 months of data, but these other ones are outperforming it. And I'm not surprised. That's what I would expect, especially if they are more closely replicating in one way or another what's going on with Bitcoin or Ethereum. You're seeing 59, 58, 60% versus 44%. But these are not paying out a distribution, not paying out a weekly distribution. So again, I invest in IBIT, I invest in BLOKS, and I like them both. I also invest in BTCI, which is a monthly payer. Also, I like. They all do something a little bit different. And here is BTCI. So BTCI, their focus is a little bit more income, okay, and they have the higher yield, a little bit less on capturing the upside, but they do a good job. They do a good job, I would say, of um, any of those other weeklies that we talked about. BTCI as a first class income based ETF that has exposure to Bitcoin. Um, but this is really going to be more market dependent. So if we were to see more volatility, like over a year or over 3 years, this chart could be inverted. So I like both. The approaches are a little bit different. One is more focused on price appreciation. The other is a little bit more focused on income. All right. Total return, well, it's a little bit closer. All right. So, how does BLOKS compare against other income-based ETFs that are not income or I'm not Bitcoin or crypto or blockchain focused? Well, year to date, it's doing better than all of them. And I love GPIQ and I love QQQI and SPYI. These are some of my favorites. It's even doing better than the index fund ETFs, SPY and QQQ. But that's year to date. And that's really just a reflection of some of the market volatility. BLOKS has an advantage because they are investing in assets that are doing very well uh, in the blockchain space. And they also have another layer, an income layer. And here it is for 1 year. They're still outperforming them. So here's one thing worth mentioning. I want to be completely fair. What is outperforming? Is anything outperforming BLOKS? Because there's one thing I've learned as an investor that you're always going to find something that's performing a little bit better at one point in time or another. Here, year to date, and this is another new ETF. I've actually done a video on this, and this is Wild. And this is a leverage based ETF. It's a momentum based ETF, and it's managed by Vista Shares. They're a phenomenal investment firm. They're actually outperforming BLOKS, so they're doing better at this point. I own them both. I like them both, and neither have NAV erosion. So I just wanted to mention that. And if you own Wild, that's a good choice. If you own BLOKS, that's a good choice. Um, and not advice, just my opinion. I own them both, and I'm happy as a clam. So, why am I telling you all this? I truly believe that BLOKS is a special income based ETF. They're generating that consistent weekly income, um, and they're also getting good upside. They're capturing a lot of upside, and this weekly distribution that they're generating in this digital asset space, I believe, is pioneering. And why is it? They're not the first ones to do it, but they're doing it without NAV erosion, and they're outpacing several highly regarded income-based ETFs that I own and I like. And I mentioned SPYI, QQQI, GPIQ, and others. And they're maintaining NAV stability. And with an income based ETF, that's really what I want to see. I want to see a stable or a growing NAV. And paying it weekly, that takes some doing. So my hat is off to these guys at Nicholas Wealth. So, in sum, what does BLOKS do? They do not cap their upside like some of these others. They do not over distribute, and they are basically having leveraging a very thoughtful options-based strategy to allow for partial upside capture. And to me, this results in what we would have is a superior risk-adjusted return. Just a really good job. They're superb. That's really all I have to say on that. So I hope you found this to be informative and useful, and I thank you for sticking with me. If you found this to be useful, please give us a like, share the video with a friend. If you have not subscribed, hit the subscription button. If you've already subscribed, don't hit it again or you're going to unsubscribe. And hit that notification bell, and you'll be notified of our next video. You can see that we are on other platforms. We're on X, Instagram, and Facebook, so you can see our QR codes and our handles. And one friendly reminder, as an affiliate partner of Seeking Alpha, I can extend subscription discounts to you for the premium membership. 7-day free trial, and I want to say $30 discount. Alpha Picks, $50 discount. Alpha Picks, you get 2 free stock picks every month from their great analytical team. With the premium, you're going to get up-to-date stock and ETF quotes and insightful articles and analysis. I love it. The links are below. The QR codes are there. Check out those discounts and feel free to subscribe. 7-day free trial for premium, just to mention that. And if you decide you want to cancel it before 7 days, you can do it, but I think you will like it. I actually subscribe to both. I've subscribed to both for many, many years. I love them. All right. And this video has been brought to you by Dividend Blasters. Until our next video, have a wonderful day. God bless.